Welcome to the Deep Dive, where we really dig into the stories behind the headlines. Today, we're plunging headfirst into, well, some serious market drama. You probably felt it, even if you weren't glued to your screen.
Oh, yeah.
Remember that sudden, kind of stomach-lurching drop? Happened around 10 a.m. on that big announcement day recently. Bitcoin, Ethereum, Solana, even the NASDAQ and gold, everything just took this dizzying tumble.
Yeah, a real pin waterfall, as we're calling.
Exactly, a pin waterfall. You were probably thinking, like, what on earth just happened?
It was definitely a moment that sent ripples everywhere.
Yeah.
Crypto, traditional markets, lots of people got caught off guard. And yeah, that pin waterfall term, it's when prices just plummet so fast, so sharp across different assets, and the chart leaves this long pin or wick, shows that massive sudden reversal. That's exactly what we saw.
It really felt like the floor just vanished. So today, our mission is basically to unpack that. The immediate fallout, sure, but also the longer term stuff from that U.S. non-farm payroll, the NFP data release. We want to get into why the market reacted like that so drastically. What were all the factors, behind the chaos? And crucially, what's next? Especially for Bitcoin, Ethereum, Solana.
And we should also touch on some trading strategies, things that can maybe help navigate these pretty volatile times. We've been digging through insights from market experts on this.
Exactly. We've waded through a ton of expert takes, market analysis, trying to pull out the core logic for you, get beyond the headlines, into how this stuff actually works.
Okay, so let's set the scene a bit. Picture this. The market's kind of holding its breath. Everyone's watching the clock. It's 8:30 a.m. and that NFP number is about to drop.
Yeah, the big one. The Fed watches it like a hawk, right? For clues about interest rates.
Precisely. And rate cuts, generally good for markets. Cheaper money, more liquidity, makes riskier assets look, well, more attractive.
So that NFP data is huge because it feeds right into what the Fed might do. Lower rates usually mean assets like crypto, often seen as higher risk, suddenly look a lot better to investors.
Exactly. So naturally, there's this massive anticipation. People were positioning themselves, hoping for, good news.
And some were pretty bullish about it, weren't they? We saw folks opening multi-longs, these leveraged buy positions, even before the data hit, like around 8 a.m. Ethereum, for example, saw longs opened at roughly 4,396 and Solana around 206. People were definitely betting on a positive surprise.
They were, which, brings up a good point. Betting heavily before the data actually drops, it can be risky, especially with NFP. It can surprise you.
Right. Isn't that kind of dangerous?
Well, the expectation was for a positive outcome, but yeah, it highlights that classic issue, right? Confirmation bias.
Yeah.
You see what you want to see, and then boom, something unexpected happens.
And boy, did it. Just a couple hours later, on 10 a.m., that optimism just evaporated. We saw that pin waterfall you mentioned. Bitcoin, NASDAQ, gold, all tumbling hard.
Yeah, Ethereum dropped about 4 points in just an hour? Looked like a huge red candle on the chart. Just a brutal reversal.
So fast. So why? Why such a violent reaction, especially people were initially hopeful?
Well, the core of it was this massive miss in the data. The market was generally looking for around 75,000 new jobs.
Right.
The actual NFP report, it showed only 22,000.
22,000, that's wow, it's a difference of 53,000 jobs.
Exactly, 53,000. It's not just a miss, it's kind of shocking.
Huge miss. And it wasn't just traders who were stunned, right? Didn't a White House advisor actually question the number almost immediately?
Yeah, that's right. Called it too ridiculous or false, asked for correction right away.
So what happens then? When the official data gets publicly doubted by, people in power, that must have just thrown gasoline on the fire.
Absolutely. It ramps up the instability like crazy. Because now it's not just about the number itself, it's about trusting the whole system, the data we rely on.
Right.
That kind of doubt. It translates directly into sell-offs. People start questioning everything.
That erosion of trust. That's a big deal.
Yeah.
But here's another layer, right? Experts were saying that even without this NFP bomb, the market was already showing signs of weakness.
That's a critical point.
Bitcoin, for instance, had been, what was the phrase, forcibly pulled up for 3 days straight.
Yeah, or ray, meaning sort of hollow or artificial.
Okay, what does that actually mean in this context? Forcibly pulled up or hollow? Why did that suggest the rally couldn't last?
Well, it basically means the price increase wasn't really backed by solid, widespread buying.
Yeah.
Not strong fundamentals or a big institutional interest. It might be more driven by short-term hype, maybe retail getting excited or people covering short positions quickly.
Okay.
So the rally is fragile, like a house built on sand. Doesn't take much to knock it over.
And the NFP data was that push.
Exactly. The NFT shock just delivered that push.
So the market was kind of ripe for a fall anyway. The NFP just sped it up dramatically, and that speed, that brings us to liquidations, right?
Yes. The speed was amplified by liquidations.
Leveraged longs, especially around that 480 mark for some assets, got cleared, meaning forced selling.
That's right. When prices drop fast, leveraged positions hit their liquidation points. Exchanges automatically sell them off to cover the losses.
Which forces prices down even more.
Exactly. It's a cascade. More selling triggers more liquidations, which triggers more selling. A real domino effect.
Oof.
And adding to that pressure was what some experts call a stacking effect, John Beman. Basically, big outflows from U.S. stock ETFs in the days leading up.
Ah, okay. So money was already leaving the broader market.
Yeah. When big funds start selling, it creates this cumulative pressure. Other investors see it and think, maybe I should sell too, especially when assets are already near record highs. It just snowballs.
Okay, so you had this convergence, underlying weakness, the NFP shock, forced liquidations, and money flowing out of ETFs. That explains the sheer speed and breadth of the drop.
Makes sense of the chaos.
Now, something that seems particularly interesting in all this is Ethereum. What's going on there? There's this trend people point out. The Ethereum Foundation selling off its own ETH. Why would they do that, it seems? Counterintuitive.
It does seem strange on the surface, yeah. And it's happening while ETH's price has been lagging Bitcoin quite a bit recently.
Lagging how much?
Well, some analysis suggests, based on historical ratios, if Bitcoin's at, say, 110,000 USD, Ethereum should maybe be closer to 9,000 or 10,000 USD, but it's nowhere near that right now.
Wow, okay. That's a significant gap. So are there structural reasons why ETH is lagging Bitcoin?
Experts point to a couple of things. First, decentralization. Ethereum is decentralized, but maybe let's say relatively centralized compared to Bitcoin's setup, especially around governance and development.
Okay.
Second, supply. Bitcoin's got that hard cap, 21 million coins, period. Ethereum supply is different. It's actually constantly evaporating because of the burn mechanism introduced with EIP 159. Different dynamics.
Right, the burning. So this foundation's selling. It creates short-term selling pressure, obviously. But is there a longer-term argument for it?
There is. It's a bit paradoxical. The argument is this selling is actually necessary for Ethereum to achieve, true decentralization.
How so?
The thinking is, if the foundation holds too much ETH, it could be seen as a central point of control or influence. By selling off, they reduce that perception. It helps Ethereum become more of a neutral, robust infrastructure layer for everything else. Stable coins, other tokens, you name it.
So it's like they need to step back to let Ethereum truly stand on its own as this foundational piece of the crypto world, even if it hurts the price in the short term.
Exactly. It's playing the long game. Divesting now, even with the headwinds it creates, could be crucial for Ethereum's ultimate vision of being this decentralized world computer.
That actually makes a lot of sense, thinking bigger picture. Okay, so for everyone listening, the big question is, what now? We've looked at the chaos, the underlying currents. What's the general feeling going forward?
Well, despite that sharp drop, the expert consensus seems to be this was more of a small pullback, not necessarily the start of a major crash.
Okay, that's reassuring.
Yeah. The market's seen as being in a multi-empty war right now. Basically, bulls and bears are locked in a tough fight. Lots of back and forth, but not a clear runaway downtrend.
A battleground, essentially.
Pretty much. And the big underlying positive, it's still there. The strong chance the Fed will cut interest rates, probably 25 basis points, maybe even 50 this year. That's still a major long-term tailwind for crypto.
Right. The rate cuts are still on the table. Okay, let's get specific. Bitcoin, BTC. Given everything, what are the experts forecasting? Short-term, long-term?
Okay, for Bitcoin, the expectation is maybe a short-term adjustment down to around 109,000 USD. That's seen as a key support level.
Okay.
But then a rebound is predicted pretty quickly, maybe back over 112,000 by Saturday morning, September 6th, around 8 a.m. or so.
That's specific. Wow.
Yeah, some analysts get very precise. The absolute deepest correction they see potential for is maybe 105,000 to 106,000. Strong buy orders are expected there.
And longer term, towards the end of September.
Longer term, the outlook is still positive. Could see rises to 117,000, 118,000, possibly even 120,000 to 125,000 by month's end.
Okay, decent potential upside then. What about Ethereum, given its recent lag?
Ethereum's got a bit more of a short-term challenge. Breaking 4150 USD seems tough right now. A relatively safer spot to maybe consider long positions could be around 4210 down to 4160, near that 2-hour trend line support people are watching.
And a stop loss.
Definitely.
Yeah.
Maybe around 4140 or 4130. For short-term profit targets, perhaps 4500, 4600.
And longer term for ETH?
Longer term, potentially 5100, 4300. There's even some optimism it could hit 5000 this month, which is interesting because September often has that Black September reputation, you know, historically volatile or down.
Yeah, interesting counter narrative there. Okay, and Solana. SOL's been looking relatively strong.
Yeah, Solana's held up better, generally less fund outflow compared to ETH. The chart looks pretty good, technically speaking. Beautiful, as one analyst put it.
Okay. Entry points for SOL.
A suggested safer long entry is around 202 USD. Stop loss maybe at 198.
Targets.
Short-term target 213 USD or higher. Longer term potentially climbing to 260 with maybe 230 achievable this month.
Got it. Now let's shift gears slightly to trading philosophy, because forecasts are one thing, but how you act on them is critical, right? Especially in choppy markets.
Absolutely fundamental.
First point seems to be about position sizing. Sounds basic, but easy to forget. Don't over-leverage.
Crucial. Experts really hammer this home. If you're using high leverage like 100x, limit that part of your portfolio. Maybe only 15% of your total capital.
So if you have 10,000 USD, you're only using maybe 1,500 for those high leverage plays.
Exactly. Avoid going all in or using full margin. It's just too risky.
And the second point, stop losses. They're not optional.
Non-negotiable. It's your safety net. Preserve your capital, set it and respect it. Like we said, maybe 4160 or 4130 for ETH, 198 for SOL. Whatever your strategy dictates, one bad trade without a stop loss can wipe you out.
Okay, now this next one might ruffle some feathers. The constant short-term trading. Buying low, selling high, multiple times a day.
Yeah, experts are pretty blunt about this. It's extremely difficult to profit consistently doing that in crypto.
Even for pros.
Even for pros. One expert mentioned their own success rate on those quick flips is maybe 50-50.
Which is basically a coin toss.
Right. You're fighting fees and slippage too. It's a tough game.
So what's the alternative they push?
The big one is embracing rolling positions. Jane is the term often used.
Rolling positions, what's the idea there?
It's about capturing the big moves, identifying those strong single direction trends, what they call unilateral markets. These tend to happen maybe every month or two. Instead of scalping tiny profits, you get into a position based on that bigger trend and you hold it. You roll your position, maybe adding to it on dips, riding out the smaller fluctuations, aiming for the much larger gain from the overall trend.
So it requires patience, not panic selling on every little dip.
Exactly. Patience is profit in this view. Don't get shaken out by the noise. Wait for the real signal, the bigger wave. It sounds simple, but emotionally, it's very hard when things are moving fast.
Yeah, discipline is key. Seeing past the hourly noise to the bigger picture.
It takes real discipline to stick to that. Ignore the urge to constantly fiddle.
Okay, so let's recap. We've dug into that NFP shock reaction, explored the mix of factors driving the market, the weakness, the liquidations, the outflows, Ethereum's unique situation. We've looked at forecasts for Bitcoin, ETH, and Solana.
Right. And covered some core trading principles. Size your positions responsibly, always use stop losses, maybe rethink constant short-term trading.
And consider the power of rolling positions for capturing those bigger trends. It's fascinating how this recent jolt, possibly triggered by false data, shows just how sensitive markets are.
Definitely. Sensitive to information, even flawed information.
But maybe the deeper lesson here is how that short-term craziness can distract from bigger shifts, like Ethereum's long march towards decentralization.
That's a great point. Those underlying structural changes are just as important, maybe more so in the long run, than the daily price swings.
Absolutely. So something to think about. How does your view change when you zoom out? Look past the hourly candles to those bigger structural moves. And maybe more importantly, what kind of discipline does it take to actually ride those waves instead of just getting caught in the chop?
Good questions to ponder.
Next time, we're going to dive even deeper into strategies. We'll dedicate the whole session to unpacking rolling positions and also hedging. Really get into the logic behind trying to build sustainable profit in this incredibly dynamic market. We'll explore how to try and ride those big waves effectively.
Looking forward to it.